Hey guys, welcome back to Andrew Invest. Today I want to talk about ISAs. So on Friday, the Financial Times announced that the UK government has been talking to various senior executives at various finance companies in order to strum up ideas on how to encourage people to actually use stocks and shares ISAs and specifically use them to invest in UK companies. Among these is a floated idea of having an additional ISA allowance which allows you to invest in UK companies only. Now, in this video today, I want to discuss what I think of these ideas, why the government is actually trying to impose them in the first place, and how likely they are to go through. So without further ado, let's get right into it. First of all, what is an ISA account? So ISA stands for Individual Savings Account, and any account that is marked as ISA pays zero tax on any profits made within that account. Now, that's profits whether it's interest, bond payments, capital gains, or dividends. So it's a pretty useful tool if you are a UK investor, and everyone in the UK gets £20,000 per year allowance to put into these accounts. Currently, there are 4 different types of ISA account: the Innovative Finance ISA, the Lifetime ISA, the Cash ISA, and the Stocks and Shares ISA. One of the key ideas coming from these high-level meetings was to effectively combine the Cash and Stocks and Shares ISA so that you can buy stocks and shares in your Cash ISA account. And this would be particularly useful as the majority of people in the UK who have an ISA only have a Cash ISA. And this would allow them to a lot more freely be able to invest in stocks and shares without having to open a new account and be worried about potentially being in breach of the rules. So if Cash and Stocks and Shares ISAs are to be combined into one account type, what will become of Lifetime and Innovative Finance ISAs? Well, the idea seems to be that they will be discontinued, with Innovative Finance ISAs barely having any uptake anyway, and Lifetime ISAs being considered too complex by many in the industry, and many companies are already kind of reluctant to open or allow account types of LISA because they're worried about getting sued if investors aren't properly aware of the exit fees on them. Now, what will happen to the people who already hold these account types? Well, nobody knows, but I don't think they will screw us over too badly because they might get into a lot of political hot water for doing so. I personally own a Lifetime ISA and I will be waiting with bated breath to see what happens with this ISA shakeup. Now, what about the most radical idea of all? Giving us a potential ISA allowance increase in order to invest only into UK domiciled companies. Well, the UK government has shown that it's really serious about trying to encourage domestic investors to invest more into UK-based companies. And it's shown that recently by agreeing a deal with various pension companies that would voluntarily cause them to invest around 5% of their investors' money into UK-based startups. Now, that was a really controversial deal as it did obviously decrease choice in people's pensions, meaning that they couldn't really choose whether they wanted to invest in startups. The pension fund would just do it for them. But I do think that it is a noble goal for the long term, regardless of the way that they're doing it. The UK doesn't have much in the way of domestic investment, and it is a massive drag on the country in the long term. Now, I do think this idea to provide extra allowance for investing solely into UK companies is a good one, and it's effectively a carrot to the pension idea's stick, as it allows investors to choose whether they want to pay some extra money into an ISA and actually invest into UK companies, which will benefit the country in the long term. The current ISA system can basically mean that investors don't benefit the UK at all. After all, they're not paying any tax on any capital gains, and they can just invest into companies in the US, for example, and effectively provide no funding for UK companies. Now, around 12 million people invested into ISA accounts last year in the UK, and that might seem like a large number to you, but the reality is that those numbers have been declining for years now, despite the population increasing and the ISA allowance also increasing. Now, ISAs are one of the best tax benefits you can get as an ordinary person in the UK, and thousands of people have become millionaires without paying any tax at all, purely from contributing to their ISAs. But did they become millionaires by contributing to cash ISAs or stocks and shares ISAs? Well, the answer should be obvious, and the answer is obviously stocks and shares. You'll never become a millionaire unless you've been putting money into an ISA at 20k per year for 50 years, because the interest rate on cash will just never beat the return on stocks and shares in the long term. With this kind of incentive, you would think that the number of cash ISAs is relatively low when compared to stocks and shares ISAs, but the reality is different, with most Brits still, in my opinion, considering investing to be gambling, and also with the barriers I mentioned previously. So if the government was to combine stocks and shares ISAs with cash ISAs, I do think it would be a good idea, as it would remove some of the barriers that people have towards investing and potentially help them to become rich in the long term, as well as the country to get more financing in the long term. The UK stock market has been described as the Jurassic Park of stock markets in the past, and it's not that far off the truth, with it having relatively few tech companies and lots of old world, old school companies like mining, pharmaceuticals, and so on. And this does raise the question, will UK investors be exposed to underperformance and potentially losses in the long term by investing into UK domiciled companies? And that may potentially be a risk, but ultimately the real reason why the UK has underperformed and has a lack of tech companies is because of the lack of domestic investment in the long term. So it's kind of a chicken and egg scenario. I personally do believe that we're on the right tracks with trying to encourage people to invest more money into the UK. And if you only look at the numbers back in the 1960s, over 50% of UK shares were owned by UK individuals. Currently, that number is very similar in America, for example, but in the UK, it has declined to only 12%. This means we're almost entirely reliant on foreign direct investment into the country in order to finance projects, as there's no domestic investor base. And this has led to issues with many companies not fetching the same kind of valuation in this country as if it were listed in another country. And we can see that with ARM, the UK's pretty much largest tech company. It decided to list solely in New York rather than London because the owners knew that the company would fetch a far higher price in New York than in London. And this has also led to many other companies also wanting to switch from London to the US. And it's just not sustainable for a country like the UK, which is proud of its status as one of the biggest financial hubs of the world. It might not come as a surprise that I personally am in support of these proposed changes to the ISA system, but I do also wonder how much bias has come into play in the meetings between Jeremy Hunt and these senior executives at the finance companies, because obviously their interests aren't necessarily aligned. The finance companies only really care about making more profit, whereas obviously they don't care as much about the UK profiting in the long term. So I do wonder how much talk was had about other potential ideas which would benefit the country but not necessarily the finance companies. One change that I think would help the UK significantly in the long term is the abolition of stamp duty on UK shares. Now, for those of you who don't know, you have to pay 0.5% of any buy transaction to the government as tax. And this doesn't make the government a huge amount of money in the long term, but it does mean that buying foreign shares is actually cheaper than buying British shares. For example, even with the FX fee, if I go to Trading 212 and I buy a US stock, it costs me around 0.15% FX fee. Whereas if I buy a British stock, it costs me 0.5%. Even with the FX fee from selling the shares, it means that I come out on top without any price movement at all in the share price if I buy a foreign stock. So it would massively encourage the buying of British stocks if this was abolished. But obviously, trading platform providers like Hargreaves Lansdown, AJ Bell, etc. wouldn't make any money from stamp duty being abolished, as they never made any money from it in the first place and it just wouldn't have any impact on them. So they probably kept quiet about it, in my opinion. But overall, what do you think about these changes in the ISA regimen? They're not confirmed yet, but I do personally think they are likely to go through, especially as Hunt's changes with the pensions were quite radical and they went through recently. Let me know in the comments below, and if you did find this video useful, please leave me a like and subscribe.